Okay, so it's February 10th, 2026, and if you look at the markets, it's pure euphoria. Everyone is all in on the AI boom. But what if the party's about to end? A brand new report is dropping some serious truth bombs, revealing some major cracks just beneath the surface. So let's break down what's really going on.
I mean, just look at the excitement out there. You've got the South Korean stock market, the Kospi, just completely smashing its all-time high, blowing past 5,300. And what's driving this? It's almost entirely this global frenzy for anything and everything AI. It's pushing valuations to levels we've never seen before. You can just feel the optimism in the air, right?
And listen, this isn't just hype or market chatter. The corporate investment is just staggering. I mean, get this. Alphabet alone has announced a plan to spend $185 billion on AI infrastructure just this year. That is an unprecedented amount of money. We're literally in the middle of one of the biggest capital investment cycles in history, all because big tech is in this massive race to build out the future of AI.
Okay, so all of this brings us to the big question, the real heart of this entire explainer. Are we on the brink of a genuine productivity revolution that's going to lift everybody up, or is this just a dangerous speculative bubble fueled by hype that's just waiting to pop? Well, the report we're digging into today, it argues things are leaning heavily towards that bubble bursting.
So the core idea, the central thesis of this entire report is something they're calling the Great Decoupling. The argument is that there's this huge and frankly growing disconnect between the insane valuations we're seeing in tech and finance and the kind of stagnant reality of the real economy, where most of us actually live and work.
And this slide just lays it out perfectly. Look at this. On one side, you've got hundreds of billions of dollars flooding into AI. On the other side, the latest numbers for U.S. retail sales showed 0.0% growth. Zilch. So, technology's booming, but the average person isn't actually spending more money. That, right there, is the Great Decoupling in a nutshell, and it's a massive fundamental weakness in this whole story.
So, you might be asking, okay, how do they actually make the case that this is a bubble? Well, the report lays out 4 critical warning signs that suggest this whole AI boom is built on a really fragile foundation. Let's walk through each one.
All right, warning sign number 1. The report calls it the illusion of productivity. The idea here is pretty simple. All this incredible AI tech we're seeing, it isn't actually making the wider economy stronger. Why? Because the benefits just aren't being shared. And that creates a really deep fundamental weakness.
This idea is actually based on the work of Nobel laureate Simon Johnson. His theory, it's called shared prosperity theory, argues that new technology can go one of 2 ways. It can either augment labor, make workers more productive and get them paid more, or it can just automate their jobs away. And the report's conclusion? Today's AI is focused almost entirely on automation. It's replacing workers, which concentrates all the wealth at the very top, and that in turn weakens the very consumer demand you need to keep the whole economy going.
Okay, on to the second warning sign. This one comes straight out of the history books. You see, there's certain things that tend to happen in financial markets only at moments of extreme, over-the-top optimism, which is usually right before a major crash. The famous analyst Ken Fisher pointed these signals out a long time ago. First up, you've got the Century Bond. Alphabet just recently issued bonds that won't get paid back for 100 years. Think about that. That kind of crazy long-term bet only happens when investors have absolutely zero fear about the future. And second, the valuations they're off the charts. The price-to-sales ratios for a lot of these AI stocks are basically pricing in decades of perfect, uninterrupted growth. That's an assumption that almost never, ever pans out in reality.
Now, the third warning sign is a bit different. It's not about spreadsheets or financial ratios. It's about psychology. It uses this really fascinating theory called socionomics to argue that the collective public mood is starting to sour. And that, my friends, is a really powerful warning sign for the markets.
So here's the key takeaway from socionomics. It's the social mood that drives the market, not the other way around. It's so counterintuitive. When we all feel good as a society, we take risks, we buy stocks. But when that mood turns sour, we get scared and we sell. The theory suggests that things like rising political scandals aren't the cause of a bad mood, they're actually a symptom of it. It's a sign that society as a whole is shifting from optimism to anger, a shift that very often comes right before a big market decline.
And that brings us to the final warning sign. This one is pure numbers, straight from a sophisticated financial model. And the argument here is that the market is structurally set up to fall way faster than it rises.
Yeah, this slide really puts it in perspective. After crunching all the market data, the report's model found that bad news ramps up market fear and volatility by 18% more than good news calms it down. What does that mean? It means the market is basically like a coiled spring right now, just primed to overreact to the slightest piece of bad news. A tiny shock could trigger a massive sell-off.
Okay, so we've got all these warning signs. How does this all come together into an actual forecast for the future? Well, the report takes all this data and runs a massive computer simulation. We're talking 10,000 possible outcomes for the rest of 2026. And those thousands of possibilities were then grouped into 3 main scenarios.
So here's what the model spat out. There's a 55% chance of the base case, which is the AI bubble collapses into stagflation. That's a nasty mix of low growth and high inflation. Then there's a 25% chance of a Goldilocks scenario, where everything is just right and the AI boom turns out to be real. And finally, there's a 20% chance of a real tail risk event, where a geopolitical crisis triggers a severe deflationary bust. Think falling prices and a deep, painful recession. All right, let's break down that most likely scenario. The trigger is that the weak consumer we talked about finally causes corporate profits to really disappoint. The S&P 500 would see about a 15% drop, and interest rates would stay stubbornly high. In that kind of environment, the report projects investors would just flee to safety, pushing the price of gold up to a frankly stunning $4,800 an ounce.
But what about the good news? The optimistic case here is that all the big promises of AI actually come true. If that happens, you'd see wages and spending pick up, and stocks could just keep on climbing, with the S&P 500 blowing past 6,000. This is the perfect soft landing everyone hopes for. But the model only gives it about a 1 in 4 chance. And then there's the dark horse scenario, the real wild card, a major geopolitical shock. We're talking a serious escalation in the US-China conflict or a much wider war in the Middle East could trigger a full-blown global panic. If that happens, markets could fall by more than 30%. And while oil might spike at first, it would probably collapse pretty quickly as the entire world slides into a deep recession.
So, what are we supposed to do with all this? What's the big takeaway? How is anyone supposed to navigate this kind of complex environment? The report wraps things up with a clear strategic outlook and a really powerful metaphor, the last financial waltz.
And the strategic advice is pretty straightforward. The report sees those super popular AI stocks as extremely high risk right now, mainly because of those sky-high valuations. It's kind of neutral on government bonds since they're caught in this tug-of-war between inflation fears and recession risks. So, what looks good? The most favorable asset class, according to this analysis, is gold and other hard money assets. You know, physical things that hold their value, which could be a real safe haven if things get chaotic.
And this all leads us to the report's final thought, which, I gotta say, is incredibly poetic. It reads, "We are now hearing the last song of a great waltz. The time to find an exit is approaching." Wow. It just perfectly captures that feeling of being at the peak of a huge party, right in that moment before the music suddenly stops. And so, that leaves us with one final, massive question. Is this analysis right? Are we really living through a historic decoupling of the financial markets from economic reality? The evidence laid out here is pretty compelling, I have to say, and the next 10 months are going to show us whether this great waltz is truly coming to an end.